Chapter 2. Accounting and Finance. The income statement. Initial dialogue.
Congratulations, Mary. You had a successful launch of your new product.
Thank you, Fred. I am as happy as you probably are now that you don't have to breathe down my neck to see if I am meeting my budget.
Mary, my job is not exactly to pester you with incessant questions about your sales performance against your budget.
Oh, what is it then?
Our function here is to give you necessary accounting and financial support for your sales and marketing efforts. Speaking of your efforts, I see that the results are not quite what we expected.
What do you mean? The sales are 20% over the first-year projection. I don't have to remind you that these sales are not easy to come by. I had to work very hard to achieve these results, you know.
I appreciate your hard work.
Do you? It is not like sitting back in a comfortable office hoping that somehow a miracle will happen. You have to go and get them.
I always admire your aggressiveness, Mary. But I am talking about the bottom line.
What line?
MBA lecture, the income statement. The income statement represents a company's sales, expenses, and profit, loss, over a period of time. Sales minus expenses equals profit, loss. Sales represents the revenue earned during the period through selling the company's products or services. Expenses represents the cost associated with running the business. They are usually divided into cost of goods sold and selling, general, and administrative. Cost of goods sold, COGS. These are direct costs related to the manufacturing of a product, for example, materials and labor, people directly involved in the production process. Selling, general, and administrative, SG&A. These are indirect costs related to the sale of products or services and to the management of the business. This includes salaries of office workers, rent, and advertising cost. Depreciation. This represents the value of an item, car, computer, or factory equipment that is written off, subtracted, in a given year. This may be done on a straight line, same amount each year, or accelerated, amount is greater in the early years, basis. This is a non-cash expense item. In an income statement, there are different levels of profit. Gross profit, gross income. This represents the difference between sales and the cost of goods sold. If you divide the gross profit by sales, you will get the gross profit margin, which can be compared to previous years or to competitors to measure a company's manufacturing efficiency. Operating profit, operating income. This represents the difference between the gross profit and the operating expenses, indirect costs such as SG&A. Again, if you divide this number by sales, you will get the operating profit margin, which measures a company's operating efficiency. Net profit, net income. This is known in business as the bottom line. It represents the difference between the operating profit and items such as other income or other expenses, items not directly related to a company's line of business, as well as any income taxes. Again, you can divide this number by sales to get the net profit margin, which measures a company's overall profitability. Shareholders are particularly interested in net profit, since a portion of it might be returned to them via dividends.
The income statement. Application dialogue.
Fred, I think I have a solution to our little problem.
I wouldn't call it little, Mary. Unless you are careful, you could go broke, you know.
Right. Well, this is what I think. Our sales are good, but not the bottom line. We obviously have a problem with our costs. We have to find a way to lower them.
Have you talked with our manufacturing department to see if they could reduce their costs?
Yes, I have. They say they are constantly trying to improve efficiency and cut costs. But they can achieve only marginal improvements. I think we have to go outside Japan to realize any significant cost reduction.
Go on.
I think if we outsource production to a third country, we could lower our production costs and expand our marketing efforts throughout Asia, which would improve our bottom line.
Yeah, sounds good. So you are suggesting a new project?
I am, Fred.
All right. What country did you have in mind?
Malaysia.
Why Malaysia?
I looked into several options, but I came to the conclusion that Malaysia is our best choice, mainly because of two reasons. First, we have ready access to our raw materials. Second, the country provides incentives for new foreign direct investments.
Sounds like you have done your homework. Let's see the projection.
According to my projection, we won't be making money for the first 2 years due to construction and startup costs. But we should be in the black from the third year onward.
Aren't you being a little too optimistic?
No, in fact, just the opposite. We will be shipping most of our product to Japan for the first 3 years, so we pretty much have a guaranteed market during the period. While we ship to Japan, we have to do our own marketing to find new buyers outside Japan. We have to stand on our own 2 feet, you know. To sum up, my project will kill 2 birds with 1 stone by expanding sales and reducing costs. What I will achieve at the end is a better bottom line.
Right on.
The balance sheet. Initial dialogue.
Your sales and profit projections seem all right. I can see you have put in a lot of effort to come up with this income statement.
Yeah, I had to get a lot of help from a lot of people. Bill actually walked me through the process of creating it.
Now, let's look at your balance sheet.
A balance sheet? Bill was saying something about that, but we both ran out of time. What do I need that for? My income statement says everything, namely sales, costs, and profits, doesn't it?
As far as business flow over a certain period of time goes, it does tell you all those. If you're involved in sales only, for instance, that may very well suffice. But here, we are talking about a company. The whole company. What does this company have?
Oh, this company is going to have the most modern, state-of-the-art manufacturing facility in Southeast Asia.
Okay. Where does it show in your income statement? Nowhere, right? How are you going to come up with money to build your facility? Pay for raw materials or employee salaries? Who is going to own this company? Is this going to be a joint venture?
I am thinking of inviting one of our distributors to join us as a partner. They will give us all the help we need there.
Okay. So what is the capital? How much are you going to borrow from banks?
Well, I thought those could be worked out as we go along.
Not if you want Ms. Jackson's approval.
MBA lecture, the balance sheet. The balance sheet represents the financial condition of a company at a particular point in time. It is a summary of what the company owns, assets, and how it is financed through borrowed money, liabilities, and invested capital, equity. Assets equal liabilities plus owners, shareholders, equity. Assets. Assets are divided into 2 categories, current and non-current, long-term. Current assets are those which are expected to be used or converted into cash within 1 year. These include items such as cash, accounts receivable, and inventory. Non-current assets are mainly property, plant, and equipment, PP&E. Cash. This represents all the cash holdings of a company, usually held with banks or other financial institutions. Accounts receivable. This represents the credit sales of a company, that is, sales where the customer promises to pay at some future date. Inventory. This represents the raw materials needed for production as well as the products themselves, up until the time they are sold. Property, plant, and equipment, PP&E. This represents a company's fixed assets such as office buildings, factories, and equipment. PP&E net represents the value after the accumulated depreciation built up over the years, has been deducted. Liabilities. Liabilities represent money that is owed to banks, suppliers, or other third parties. Similar to assets, they are divided into current and non-current, long-term sections. Current liabilities are expected to be paid within 1 year. These include accounts payable, notes payable, and current portion of long-term debt. Accounts payable. This represents the credit purchases of a company from its suppliers. It's in a company's best interest to collect their receivables faster than they pay their payables. Notes payable. This represents short-term bank debt, loans, or short-term borrowing from other sources. Current portion of long-term debt. This represents the amount of long-term debt that needs to be paid within 1 year, from the end of the previous fiscal year. Long-term debt. This represents the portion of long-term debt, either from banks or other sources, that does not have to be paid within 1 year. Owners, shareholders' equity. This represents the money invested in the company from outside investors, paid in capital, as well as the profits that the company keeps inside the company, retained earnings, after it pays out any dividends to investors.
The balance sheet. Application dialogue.
Fred, here is the balance sheet.
Good. Does it balance?
Come on, Fred. Of course it does.
What is the equity of this company?
It's $12 million US, $10 million from the Japanese parent, and $2 million from our local partner.
I see. What's the net working capital?
Okay, let's see. That's the current assets minus current liabilities. That would be $2 million US.
That's good. I see that this company is going to have a sizable fixed asset. How are you going to finance it?
Well, obviously with equity and long-term borrowing. This is a fairly capital-intensive business, you know.
I can see that. How is this new company going to be able to borrow so much money? No banks will.
I will ask for our shareholders' guarantee. It will be part of my proposal.
I see. All right. Let's say you got your financing scheme all worked out and fixed assets all purchased. How are you depreciating your fixed assets? Straight line or accelerated?
Straight line.
Okay. Looking at the balance sheet, I see that this venture is going to be heavily leveraged. Isn't it going to make this venture more vulnerable? The interest burden is going to be substantial. The rate itself will fluctuate too. It can go either way. But if it gets higher, it will put pressure on your earnings and add another element of uncertainty.
That's all very true, and thank you for pointing those issues out to me. In fact, I have thought about them quite a bit. As you say, we are highly leveraged. However, I am confident that we can significantly reduce our borrowings after the first 2 years.
I see. Once you become profitable, then do you plan on paying out dividends?
No, I think it's best that we retain all the profits inside the company in order to pay down our debt and to finance future growth.
Oh, I would agree to that.
Right.